This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for gains after Fed Chair Powell says the economy remains on sound ground while signalling tariff risks mean there's no rush to adjust interest rates. Wall Street snapping a two-day slide with shipmakers leading gains on US plans to loosen export rules, but ARM Holdings falling after the bell after a disappointing sales forecast. And President Trump warns that he won't lower tariffs on China ahead of high-level trade talks this week, underlining the difficult path to any deal.
Take a look at how Asian futures are setting up. We are looking at Nikkei futures now, not doing much, but this, of course, as we continue to watch the semiconductor space, we could see a little bit of a boost after news of some changes from the Trump administration. Sydney futures at the moment gaining 0.1%. We had seen some currency movements in the overnight session with the dollar rebounding for the first time in about 4 sessions or so. On the other side of that trade, we had weakness for the Japanese yen, the offshore yuan right now holding at that 722 level. But of course, all to do really with what's happening with chips. Take a look at how U.S. futures are trading early in the Asia session as well. We had seen the Philadelphia Semiconductor Index gaining ground in the overnight session. We're also, of course, reacting to Chair Powell's commentary. What was interesting was that he talked about the potential impact of tariffs, but while he was talking, we also had President Trump talking about really not preemptively lowering tariffs for China for any negotiations, Haidi. So we'll continue to watch the developments around trade as we're seeing U.S. futures down 0.1%.
We're also hearing, of course, Shery's Bloomberg's learned that the Trump administration plans to rescind some Biden-era AI chip export curbs. This comes as the U.S. and China prepare for these critical trade talks this weekend. Let's bring our national security reporter Daniel Flatley and our China correspondent Min Min Lo. Daniel, what exactly are we hearing from the Trump administration in terms of their strategy on these AI chip restrictions?
Well, what we've seen and heard from Treasury Secretary Scott Bessent, among others today, is this sort of general move toward trying to loosen up restrictions, allow more deals to happen. So Bessent was talking earlier today on Capitol Hill about this outbound investment program and wanting to kind of revise that a little bit to make the rules more clear. And I think you're seeing something similar with regard to chips, as my colleagues Stephanie Lai and Mackenzie Hawkins have reported. There is this move by the Trump administration to maybe undo some of the signature Biden policies around chips that are designated or used most primarily in artificial intelligence, to sort of loosen some of those restrictions, potentially, although this isn't explicitly stated yet, but the administration has always sort of had an eye on China gaining access to some of this more sensitive technology. So I think one of the theories of the case is that maybe you loosen up some of the restrictions on these chips for allies, countries in the Middle East being one of those potential allies or that group of allies, and maybe tighten them a little bit for China. Of course, all of this is happening in the context of broader trade talks that we're expecting this weekend in Switzerland between the U.S. and China. So a lot of moving pieces right now, but that's kind of the state of play at the moment.
And President Trump really making clear that he won't be preemptively lowering tariffs when it comes to China. Take a listen.
China says in order to have substantive negotiations, you have to bring down your 145% tariffs. Are you open to pulling back your tariffs in order to get China to the negotiating table?
No.
Min, what are we expecting from these conversations between the U.S. and China this week?
Yeah, so President Trump is saying that he's not going to preemptively lower tariffs in order to get more substantial discussions or negotiations with China. Meanwhile, both sides actually once again disagreeing on actually who called for these talks, because President Trump denied that U.S. had initiated the trade talks, while China has been explicit that the U.S. has been the party that was reaching out to China through various channels. President Trump previously also saying that the U.S. would lose nothing if China doesn't trade with U.S. He said U.S. consumers would be okay with higher prices and less selection of goods. So as we head into this weekend, it's really unclear right now whether this is just sort of icebreaker talks where both sides will try to find out what the other party wants before agreeing to more substantial trade discussions. So essentially negotiating to agree to negotiate, or is it actually going to yield some concrete outcomes which could look like maybe possibly a pause on reciprocal tariffs as Trump has done for other countries, or maybe lowering of tariffs. But then to what extent is those tariffs going to be lowered? Because economists have said that even 50 or 60% tariffs would still mean that the bulk of U.S.-China trade would be cut off. And we continue to see editorials on Chinese state media again calling on the U.S. to, quote, show sincerity, meaning they really want the U.S. to be the one to de-escalate and put its actions where its mouth is.
What are we seeing, Min, when it comes to the level of preparedness, right, regardless of what outcome we see in these ongoing trade talks? Are we seeing sort of alternative paths to growth and survival being put in place by Chinese factories?
Yes, I mean, yesterday we had the PBOC briefing where the government announced the cutting of RRR and interest rates, a slew of other measures, re-lending facilities to support exporters for the tech sector as well. And when we talk to exporters, for example, at the Canton Trade Fair that just recently concluded, we saw that many manufacturers, in fact, about 20 of those that Bloomberg has interviewed showed unanimous support for China playing hardball against the U.S. And many of these companies, of course, have already taken steps to divert the sale of the products from the U.S. to other emerging markets like Southeast Asia, like the Middle East, Europe, also another potential destination for them as well. Of course, there has been a lot of disruption. Some of these companies putting on hold their investments overseas. Some of them were looking to move production overseas, bought land in Cambodia, but we were told that they were initially prepared to start factories there, but now they're putting that on hold and just renting out their property for now, just given the uncertainty over the tariffs. But interestingly, though, I spoke to some companies, Chinese consumer sort of companies that are still looking interested in expanding to the U.S. even in this current climate, and they seem to think that U.S. is still an important market, that the consumers there are willing to spend the currency that they can earn from the U.S. would be good as well for their business. So some companies still not being put off by the geopolitical climate and still looking to expand or open up new stores in the U.S.
And yet, when it comes to the U.S., they actually want to stop those investments going into China. Dan, of course, we have seen Secretary Scott Bessent talk about those outbound investments into China and working with Congress and also taking heat from Congress.
Yeah, that's right. I mean, you know, it's interesting. Today was Secretary Bessent's first appearance before Congress, or I'm sorry, it was his second appearance before Congress since his confirmation hearing. So yesterday he appeared before another House panel, much smaller panel, the House Appropriations Committee. Today, much bigger panel of lawmakers with the House Financial Services Committee, and he did get some pushback from Democrats on. From the other side of the aisle, from the Democrats. And one of the themes that came up sort of repeatedly was the cost of goods to consumers after the tariffs really start to bite. And he defended that a bit. Surprisingly, he wasn't asked too much about what was ahead for his negotiations with China this weekend. But a couple of things to note. One thing was he was asked early on in the hearing, what do you expect to get out of these talks? Are these, quote unquote, advanced negotiations? And what he said was basically, this is just the beginning. And by definition, they're not advanced talks. The other thing that he talked a little bit about was who was going to be going with him. He said it was going to be himself leading the talks along with U.S. Trade Representative Jamieson Greer. He was asked specifically whether White House trade advisor Peter Navarro, who is known to be much more hawkish on trade, would be traveling with them. And he said, no, Navarro would not be traveling with them. And that sort of elicited a sort of, I guess you could call it a sigh of relief from one of the Democrats who said, oh, thank goodness that that's not the case. So, you know, read into that what you will, but certainly there seems to be a lot of concern about the impact to the economy from the tariffs, not just from Democrats, but also from some Republicans on the panel as well. And so he weathered that hearing today, and his big test will come this weekend as these talks get underway.
And Min, before we let you go, we know that President Xi Jinping is in Russia right now. They're celebrating or commemorating the anniversary of the end of World War II. But at the same time, with the backdrop of Russia continuing to attack Ukraine, it must be a very awkward situation.
Yeah, and not to make light of the war in Ukraine, but it's starting to seem like President Xi's trip there is almost a backdrop for political theater and this battle for influence, because just hours after President Xi landed, both sides were still exchanging airstrikes. Russia sending ballistic missiles and drones, and they were shooting down drones coming from the other side, from Ukraine into Russia as well. And meanwhile, President Xi has been silent on the Ukraine war. He penned an editorial that was published on Russian newspaper that was all about how, both countries are going to defend international fairness and justice. He also said in that article how Russia and China has always firmly supported each other's core interests. Without mentioning Ukraine, he mentioned the One China principle and how Taiwan is an inalienable part of China's territory. And interestingly, Russia is actually declaring a 3-day ceasefire as they commemorate the May Day parade. That was something that Ukraine has dismissed, and they said they won't be able to guarantee the safety of the dignitaries that are landing in Moscow. And then you have the Slovak Prime Minister actually complaining that Estonia didn't allow his plane to fly over the airspace. And meanwhile, of course, top of the agenda when it comes to Xi-Putin bilateral meeting today is all about U.S.-Russia relations, as well as China's trade, economic issues, energy issues as well. We know that China has in the past been calling for this peaceful resolution of Ukraine, but suddenly it's a very awkward sort of backdrop for President Xi to be visiting at this time with all that airstrikes just happening hours before.
Right, Bloomberg's Mimi Low there, as well as Daniel Flatley. And the Fed chair says that officials are not in a hurry to adjust interest rates. Jerome Powell saying that until they have at least a better understanding of where the economy is headed. Take a listen.
There's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that.
Global economics correspondent Enda Curran joining us now from Washington. And Enda, again, the message being that they're in no rush, but at the same time, the markets were pretty muted compared to what he said and what happened around that meeting in April.
Yes, there wasn't, a dramatically new message from this Fed meeting today. A couple of key takeaways were the point that the Fed officials make it clear that the economy right now is in good shape. Chairman Powell himself said in the press conference the economy is basically fine at the moment. So that was important because of the whole debate about the soft sentiment data versus the hard data. The second takeaway from both the statement and, of course, the Fed chair was, however, that they are worried that such is the level of uncertainty right now that people could start to lose their jobs at some point. Unemployment will go up. At the same time, the prices are going up. So that's obviously a scenario that no central bank wants to be. So they flag that as a key risk. But ultimately, though, laced throughout those remarks in the press conference, the Fed chair repeated time and again that it's just too soon to know where and how the trade policy plays out and how it impacts the economy. And at one point, he made it clear that it looks like right now the administration is going to go off and start its round of talks with trading partners and maybe come back with some deals. The Fed is very much outside of that process. They know no more than anyone else, so they need to wait and see where the tariffs settle to start judging how it will impact the broader economy, broader consumer sentiment and the like. So very much a theme of, yes, we have some concerns here. We are worried about what might happen, people's jobs and the prices of goods. But honestly, the key takeaway was they don't yet know, and they don't want to give too much direction about where they think things are going until they get some clarity on these trade talks.
And he's really said that it's not really a situation where they can sort of preemptively, protectively do anything until the data becomes a little bit more obvious. Is there a single indicator that we should be watching that could be kind of the factor that forces the Fed to move?
Yeah, I think it's a really interesting part of it because you have a debate going on now among Fed watchers saying, wait a minute, if they're warning of higher inflation Will that be the bigger concern for them if the duties on goods start pushing up the prices of everything? Or on the other hand, the other side of their mandate, if people start to lose their jobs and unemployment goes up, will that supersede everything else and they'll swing back to that side of their mandate and start to cut? Chairman Powell didn't give any sort of explicit or necessary guidance on that today, but I think a lot of economists and watchers will say to you that, look, ultimately, if we are in a situation where the unemployment rate is going up and going up materially as the economy slows down, as the labour market starts to crack, so to speak, then that might be the tipping point moment for the Fed to act. Because remember, of course, there's a whole lag effect of when people start to lose their jobs and all the rest of it. The Fed would want to start moving. And I think the observation is that if we reach that point, the Fed then would start to cut in a material way. But clearly, we're not there yet. The statement made the point that the labour market is robust. The Fed statement and chair made the point that the economy is holding up pretty well. I think it's all about what's going to happen in the months ahead, really, and just where this tariff shock lands. So much of this is we're flying blind right now. It's a lot of worries and concerns. It really is a question of just exactly how and where all of this does land.
And we're hearing from the National Economic Council Director Kevin Hassett right now speaking on Fox News, saying that he respects the independence of the Fed, that he doesn't always agree with the Fed's Chair Powell on policy. And my first question in my head was, okay, so he respects the Fed, but does President Trump? Did Chair Powell say anything on the political pressure coming from the president?
It came up a couple of times. The reporters asked him, sort of for his views on the ongoing Trump criticism of the Fed, but he wouldn't bite, he wouldn't engage in that. He doesn't want to play that game, obviously. But that is the big backstory is here, of course, that President Trump's criticism of the Fed has been ratcheted up. It's very vocal now. He's obviously explicitly said at one point he would rather not have Powell as Fed chair, but obviously, of course, he said he also won't fire him. His term is up next year anyway. And then, of course, you have the economic officials who are kind of needling the Fed in their own way, maybe not as explicitly as President Trump, but making the point that they're watching closely what the Fed is doing. And they certainly have been critical in their own way at times. But Chairman Powell certainly brushed off that today. He wasn't engaging in any of it. He was setting out his own message, and his own message is that, yes, they have their concerns about the economy. There's so much uncertainty. In particular, they're worried the economy might be heading for stagflation. But he also made it clear that they don't know. And right here, right now, they just have to wait and see how all of this plays out. And that was the central takeaway from that Fed meeting today.
Bloomberg's global economics correspondent Enda Karen, and just as expected, we do have the Hong Kong Monetary Authority keeping that base rate unchanged in 4 3/4%. Of course, this is a rate that moves in lockstep with the Federal Reserve, the local dollar being pegged to the greenback, of course. But of course, more interestingly is the backdrop that we've seen where Hong Kong authorities have been ramping up FX sales of the local dollar to try and keep under control some of the big gains that we've seen, not just in the Hong Kong dollar, but of course across broader Asian currencies. More ahead on the Asia trade. This is Bloomberg.
Take a look at how U.S. futures are trading early in the Asia session after U.S. stocks and bonds rose overnight. Chair Powell again signaling that he's in no rush to cut rates. For more, let's bring in MLive strategist Mark Cranfield. Mark, really the price action on Wall Street was pretty muted overnight, especially compared to what happened back in April. Is that the direction of travel for Asia today as well?
Well, it's basically unsustainable what you saw in Wall Street last night, to have the S&P 500 go higher, Treasury yields lower, and the US dollar stronger. That is not something which is sustainable, given that Jerome Powell, as Enda was saying earlier, is on the fence. So the bond vigilantes will make their own mind up. If they see the risks of stagflation rising, which certainly appears to be the case if you read between the lines of what Mr. Powell was saying there, the risks of stagflation are real. They're likely to increase in the months ahead, and the bond market's not going to like it. So just because we saw a bit of a rally yesterday, that's not really going to last for very long. So probably we get more steepening in the first place. Investors will be very cautious of the long end of the bond market as we go ahead. Treasury auctions will become increasingly difficult for the very long maturities. And then you got this big story we ran yesterday on Bloomberg about the risk of Asian centers, particularly unwinding US dollar positions. There could be about $2.5 trillion US dollars stored up between various entities in Asia. And as they lose confidence in the policies in the United States, the investors will want to dump those US dollars. Not all immediately. Of course, it would be over a period of time, but that's going to weigh on the US dollar for a long period to come. So just because we saw a fairly benign reaction last night, that is unlikely to hold. We could easily get back into this situation where the so-called sell America theme comes right back, where we see weaker stocks, weaker bonds, and a weaker dollar all at the same time.
And I guess that question goes to, whether this is a bit of a game of chicken at the moment that traders are playing, given the expectations of still 3 cuts this year.
Well, traders don't have the luxury of sitting on the fence like Mr. Powell and doing nothing. They've got portfolios to run, they've got hedges to put in place. They've got to make their decisions today and over the days ahead. So yes, they will be doing exactly that. They probably, for now, they seem to be thinking that eventually the Federal Reserve will shift more to the focus on the economy, that the employment picture will not be as good, maybe, as they're currently thinking, and that interest rate cuts will need to come. They're currently looking for about 3 interest rate cuts before the end of the year. That fluctuates between 3 and 4 cuts, but it's been pretty consistent that people in the market do expect the Federal Reserve to give in and lower interest rates. Nothing much to dissuade them from that at the moment. So that's the path of travel, but it doesn't really tell you what's going to happen to the yield curve. The yield curve probably will need to steepen because people are unsure about the inflation, just as Mr. Powell is unsure about the inflation outlook, but certainly there's more pressure to the upside. So you may well see focus on the short term where people expect the rate cuts, but the long end of the curve to lose value as people suspect that the Fed will have to give in eventually, even though inflation stays high.
Bloomberg's Mark Cranfield there. Also coming up next on the Asia trade, we get more analysis when it comes to the Fed's rate path amid tariffs and tax cuts. Mizuho Securities will be along with us. JPMorgan Private Bank also telling us why they see further dollar depreciation. Plus, we'll be getting the latest when it comes to this India-Pakistan conflict with the Brookings Center. Much more ahead. This is Bloomberg. This is the Asia trade. Let's get you the latest when it comes to the corporate headlines we're following this hour. DBS Group reporting net income for the first quarter that beat average analyst estimates, although it was down 2% compared to the previous year. Net income was $2.24 billion. DBS says tariffs and geopolitical uncertainty are clouding the outlook, also saying that it will deploy funding into non-loan assets if it sees weaker demand for loans. ANZ's profit topped estimates in the first half despite margin pressure on its retail and institutional divisions. Cash profit was broadly flat at $2.3 billion. The bank is seeking to extend the period for its $1.3 billion share buyback, citing increased global uncertainty. CEO Shane Elliott is due to step down next week and hand over to Nuno Matos, the former HSBC wealth chief. Well, Disney shares jumped after the company reported second quarter results that beat estimates and raised its outlook for the full year. Disney citing strong performances from theme parks and streaming, saying full year 2025 earnings excluding certain items would rise 16%.
We had a very strong Q2 with adjusted EPS up 20% from the prior year, rounding out a solid first half of fiscal 2025. Despite questions around any macroeconomic uncertainty or the impact of competition, I'm encouraged by the strength and resilience of our business, as evidenced in these earnings and in the second half bookings at Walt Disney World.
This is Bloomberg.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Near-term measures of inflation expectations have moved up. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient.
Fed Chair Jerome Powell, they're really urging for patience and more data to get a fuller view of the implications of Trump's tariffs and then also tax expectations for the US economy. And if you take a look at the sort of slight hawkish adjustment we saw when it comes to what traders are now looking at, what markets are looking at for the rest of the year, there's still expectations for 3 cuts by the end of the year, but somewhat heeding that call to patience. At the moment, we're seeing that first cut expected in September, a second one coming in October, and 3 by the time we see out the end of 2025. So not a massive shift, but we'll continue to watch those expectations. But also for his expectations, I want to bring in Steven Ricchiuto, who's a chief US economist at Mizuho Securities. And really great to have you in region for us and to look at, the sort of morning after the Fed. It's a tough gig that Jay Powell has at the moment.
Well, he does, but it's actually made tougher by the market's anticipation of what they're going to do, because the market has set itself up, I think, for disappointment. This
so you
is
think
similar.
What we showed there, the 3 cuts, too optimistic?
I think 3 cuts are much too optimistic. And this goes back to, again, the way the market behaved last year. They were anticipating aggressive rate cuts, and the Fed unfortunately made a mistake towards the end of the year when they actually did begin cutting rates in September, and they moved quickly, and the result was higher long-term interest rates. So I think the markets are overly anticipating the degree of economic weakness that'll come as a result of tariffs.
You don't see a recession, though. How do you expect tariffs? And I guess to me, it's more interesting the sentiment aspect, right? The confidence is already taking a dive. How businesses are making plans as though these tariffs will stay in place.
Well, I think you have to understand, businesses have a myriad of investment opportunities in front of them. Not all of them are a function of tariffs. And if I'm in a situation where I have an uncertainty about tariffs, but I have strong economic demand, I have a tight labor market, I have a tax cut coming, which is likely to stimulate economic demand further, I may not make the investment that will hinge on a tariff-related decision, but I certainly have to make other investments because I have to keep driving my company forward. I have to validate those double-digit returns that investors are looking for, and I can only do that by growing my business. So in an environment where there is no liquidity problem, in an environment where there's no systemic credit risk, you have an economy that can pivot around changes like this and not really miss a beat the way people tend to think it does.
Is that an environment where the tax policies can counteract in a strong way?
Well, there's no doubt the tax policies are going to counteract. I think people are missing the point. Tariffs are not the end. Tariffs are the means to the end. The end is a tax cut, and it is a Democrat-oriented tax cut. It is a blue tax cut, not a traditional red tax cut. It has SALT tax deductions in there. It has reducing taxes on Social Security, reducing taxes on overtime, reducing taxes on tips, reducing the interest cost, after-tax interest cost for people who borrow money to buy an automobile. All these factors are really designed to stimulate economic activity through the middle class of America, not the upper income thresholds. And I think that's a powerful, powerful tax cut.
How long will that take? And especially for all of these taxes to be passed and also to filter through the economy?
Well, I don't think it's going to take very long. I'm betting that between Memorial Day and July 4th, the tax cut will be implemented. I think it will be fully executed by September 30th. And I think by the time October 1 comes around, the idea is to have all the withholding tables adjusted, have all of the paycheck companies, human resource departments, everybody having the new withholding adjustments in place so that it can benefit the economy beginning October 1. So it gets them into the new fiscal year, and it helps lift the overall economy heading into the midterm elections, which is the driving motivation here. This administration, whether they succeed or not, is yet to be seen. But this administration, I think, wants to try to increase its majority in the House and Senate in the midterm elections, which is also an unheard of development, much as, being president, losing the spot, and then getting it again. That you have an environment in here where they're trying to do something very important in the final 2 years, and that is begin to reorganize government. And I think that's what the idea of DOGE was all about. DOGE wasn't about cutting spending today. DOGE was about finding where you need to cut spending after you get increased majorities in the House and Senate, and you have the ability to drive regular appropriations bills through Congress.
There was a concern that with the layoffs from Doge, especially with federal workers, that could actually add to the uncertainty coming from the labor market, that people would be unwilling to spend, given that a lot of people work in the government as well. Is this a concern that it could dampen overall sentiment by American consumers?
Again, I'm not a big follower of sentiment. Even the chairman indicated that at his last press briefing, that sentiment's not a particularly good indicator of U.S. economic activity. But to drive home your point in a different way, we have a labor market shortage. We're not seeing any rise in jobless claims. We're not seeing any sustained rise in continuing unemployment claims. The fact that we have a labor market shortage, if you're starting to lose some government workers, they're probably being picked up in state and local governments. They could be picked up in the private sector because there is a labor market shortage. So we're not seeing any real disruption coming out of the labor market, which is what's really boxed the Fed in here, because they have the uncertainty over the inflation, but they're also not seeing the weaker labor market would give them the justification to cut rates. And I think this Fed does want to cut rates. That's why the market's pricing it in. I just don't think the data is going to allow them to.
Before we let you go, do you think the demise of American exceptionalism is overstated?
Look, America's not going to lose its reserve currency status. It still drives innovation. It still drives technology. All that is the case. The fact that Jerome Powell was picked on by Donald Trump in this environment, we have to understand there's a long and checkered history between Federal Reserve chairmen and presidents in the United States. And, there has to be somebody else there to take over that mantle of reserve currency. And I ask you, who in the world is there to do that at this point in time? The answer is no one.
Stephen, really great to have you with us. Shery?
Yeah, Steven Ricchiuto there, Chief U.S. Economist at Mizuho Securities. We do have breaking news at the moment. We'll be watching NTT and NTT data shares in the trading session today here in Tokyo. The Tokyo Stock Exchange will be lifting that trading halt that it implemented earlier today. The lift will happen at 8:46 a.m. Japan time. The trading halt happened after we got a report from the Nikkei that NTT was planning to make NTT Data Group a wholly owned subsidiary in a deal estimated at roughly $15 billion to $20 billion. We are now hearing from NTT itself that the board will be discussing that NTT Data tender offer at a meeting today.
Well, Shery, Citibank Singapore CEO and head of wealth for Asia South, Yeo Wen-hsien, thinks that investors should stick with U.S. equities despite growing economic headwinds and challenges coming from tariff policies. However, she warns against buying into dips in an exclusive interview during the launch of Bloomberg's New Voices Singapore.
There's just too much news. The news changes every day, right? You go to sleep hearing one thing, you wake up hearing a different thing. You don't know what to do. So again, our advice is stay the course. Don't buy the dip. Look for quality, and you should rebalance your portfolio. So I think in wealth, it's all about the world's changing. So what you would do yesterday could be different from what you do tomorrow. But it's really important for clients to also know what they want to achieve in the longer term. And the role that we play is to help our clients discover, have clarity, what do they want to do in the longer term.
But give us a sense of rotation.
Yes. So it's not the time to add risk. So if you think that stocks have come down, it's the right time to go in, we're actually telling clients don't buy into the dip. You can rotate into money market funds. Look for bond funds with shorter duration assets. Look for companies with lower volatility in their earnings. I think this is the advice we're telling clients.
When we take a look at tariffs, some say that it will impact the way economies grow. In fact, there's already been projections where estimates have been cut pretty much across the board. How does that help or hinder wealth creation? How are we looking at growing the business, for instance?
Okay. So at Citi, the clients that we love are the ones who are change makers and who are creating wealth. And that hasn't changed. I think in the world that we live in, there's still a lot of innovation, a lot of creativity. So, and that's true for, corporate companies as well. So again, look for where the innovation is happening. It still continues to happen in the world that we live in. In fact, in the disruptive world, there's probably even more opportunities for, companies to differentiate themselves, for entrepreneurs to differentiate themselves. and to be disruptive as well, to kind of play into the disruption and to leverage it, create wealth, create growth, create value.
We talk about the rotation. A lot of people talk about that rotation out of the US into this part of the world. What are you seeing in terms of the regions you cover? Southeast Asia, UAE, for instance, comes under you as well. Are you seeing that?
We are definitely seeing some rebalancing. The reality is the US is a very, very big market. So we wouldn't recommend the clients to exit the US markets altogether. I think US markets, the capital markets, about like 70% of the global market. So not to have US exposure also means that you're not exposing yourself to where there's still a lot of growth, especially in the technology space.
Citibank's Singapore CEO and head of wealth for Asia South, Yao Wen-Xian, there speaking with Insight anchor Haslinda Amin at the launch of our New Voices Singapore event. More ahead on the Asia trade. This is Bloomberg.
Take a look at some of the after-hour moves. We're watching Alphabet and Apple. We heard that Apple is considering revamping Safari to focus on the AI-powered search engines, potentially ending its longtime partnership with Google. We're also watching the semiconductor space. Of course, we have heard that the Trump administration plans to rescind Biden-era AI chip restrictions, not to mention that ARM gave a lackluster sales forecast. Let's get more on ARM's results and bring in our tech reporter Annabelle Drewlers in Hong Kong. Belle, so what stood out in the results?
Yeah, well, I think, as you said, it was that weak forecast, and that really had a big bearing on the stock price, or is having a big bearing on the stock price in late trade. But actually, for the fiscal fourth quarter, the numbers came in just a little bit better than had been expected. So sales rising to $1.24 billion. But as you said, that guidance, really the big focus here, because the company is saying that revenue is going to be between $1 to $1.1 billion. But Wall Street actually had been expecting it to come in at the top end of the range, and profit as well expected to be somewhere between 30 to 38 cents, taking out certain items, and that again is less than predicted. So I mean, exactly why we're seeing this is an interesting one. So ARM is a company, we know it essentially designs software for computer chips, and then it makes money from royalties, but also licensing out their technology. And ARM is saying that it's getting very close to inking a number of new customer deals, but it's not comfortable with adding them to its revenue forecast just yet. And so it's that timing is why the forecast came in a little bit less than anticipated. But again, a weaker outlook does as well correspond to what we've been hearing from many of its peers so far in the earnings season. And again, that restriction on specific profit forecasts is something else we've heard from other companies in the tech space as well.
We're also hearing of an interesting potential change in strategy when it comes to Apple, right? They're looking to shift how they approach AI search.
Yeah, that's right. So this is something else that made some really big moves intraday, and specifically for the Alphabet stock. But just to give some context here, so we know that the DOJ, or the Department of Justice in the US, has some concerns around how Alphabet has allegedly illegally monopolized the search business, and part of that way that the DOJ would say they've been able to do that is a partnership that Alphabet has with Apple. The DOJ has been going through this lawsuit, and Alphabet was, or rather Apple was called to give testimony in this on Wednesday. And so we heard from one of the executives there, Eddie Q, who was speaking, and he essentially said that Alphabet, or Apple rather, is actively looking at revamping the Safari web search browser on its devices, and what it's going to be doing is possibly shifting to AI. Why Apple is saying they're looking at doing this? So Eddie Q said that actually last month, for the first time ever, Safari searches dipped. And why he's saying that is happening is because people are increasingly migrating to using AI instead. So they're looking at possibly integrating names like OpenAI, so that would be ChatGPT, but Perplexity, Anthropic. He's saying that these could eventually replace standard search engines like Alphabet. Of course, they have their own AI offering, but it has been a little bit behind others in the space. So Apple essentially said, yes, Apple's AI search tool could be on the list, but they're certainly not going to be the only one. And so, again, that sparked a lot of concern. But that would be a very seismic shift for the iPhone, of course, if it does go ahead and when you've got more than 2 billion devices worldwide.
Annabelle Jawlers there with the latest. And we're taking a look at the commodities complex as well, particularly in light of the sort of patience being advised by the Fed. In particular, the move when it comes to gold. We see that drop in gold, but now be reversing some of those earlier losses, up about 0.3%. But those declines being seen after Fed Chair Jay Powell said that the Fed isn't in a rush to adjust rates despite the ongoing trade war, of course. So we did see spot gold seeing some downside reaction there. We're also seeing iron ore seeing a tandem sort of move there down along with the likes of copper as well, of course, firmly focused on these trade negotiations and seeing that reaction after the PBOC rate cuts on its reverse repo rate and the reserve requirement ratio there as well. Crude at the moment holding on to those declines. That market also very much focused on the bilateral trade talks. Some of the other stories that we're focusing on at the moment, Pakistan says it reserves the right to retaliate further after India launched what it called targeted strikes on terrorist camps in Pakistani territory. Pakistan's army says 31 civilians were killed in the deepest breach of its territory since the two countries' 1971 war. India, meanwhile, says it conducted precise and restrained response that was designed to be non-escalatory in nature. Vietnam is urging companies to buy more high-value US imports to help in trade talks. The country's trade minister says energy, mining and telecommunication firms in particular should be more proactive. The US ran a nearly $124 billion trade deficit with Vietnam last year, but that narrowed sharply in April following the Trump tariff announcements. Reuters is reporting that Ukraine is starting to consider a shift away from the US dollar to using the euro as its reference currency. The report cites an email from the central bank governor saying Ukraine's EU membership ambitions and global trade fragmentation are among the considerations. Ukraine's national currency was launched in 1996 using the dollar as its reference currency. More ahead on the Asia trade, this is Bloomberg.
Toyota kicks off Japanese car earnings in the coming hours with quarterly results expected to be robust on recovering sales. But its longer-term outlook is set to veer conservative as the Trump trade war rattles the industry. Let's bring in Bloomberg Global Business reporter Nick Takahashi. Nick, so we know that we'll be watching that impact of tariffs, but what else should we just keep an eye on when we get those results?
Well, I think we're going to see a bit of a mixture of results today. For the first time, Toyota is hopefully going to give us a better yen figure of the impact it foresees on tariffs. For the most part, it's been mum on the topic. It's been staying the course when it comes to local production, any talk of moving production across borders to Mexico or Canada, reducing imports. Toyota has been keeping to the status quo, unlike some other Japanese car makers. So analysts, according to Bloomberg data, forecast about a 4.7 trillion yen outlook for the annual profit this year, and then about 4.8 for the year prior. So that would be in 2 straight years of drops in income. It's worth mentioning that fiscal 2024 was a record high, not just for Toyota, but for all Japanese companies. So it's on the decline after a really, really good high. But what we're looking at is, what we're hoping for is a proper estimate of what the impact of tariffs might be on the world's biggest car maker.
Bloomberg also recently reported that Toyota's chairman has made an offer to buy out Toyota Industries. This is such a core element when it comes to the founding business and the broader group. Have we had any update in terms of how that's progressing?
Yeah, so Bloomberg News reported yesterday that financial advisors have been appointed for all the parties involved, including Toyota Motor and Toyota Industries. We also were told by sources that the tender offer will be made as early as November. So what we're hearing is that the deal is moving forward. You know, this is the ball being kicked further down the road, progress being made in negotiations. And today at earnings, when Chief Executive Officer Koji Sato speaks to the press, beyond just tariffs, it's going to be about what he makes of the deal, whether he's involved in these talks, and the intentions behind the deal, which are very opaque at the moment.
Bloomberg Global Business reporter Nicholas Takahashi there. Let's take a look at some of the stocks that we're watching when trade opens in Japan, Korea and Australia over the next few minutes or so. Nintendo is one of them, reporting today with its Switch 2 expected to drive the fastest pace of annual revenue and profit growth in years. And that is despite the longer-term uncertainty, of course, that continues to stem from US tariffs. Also watching SoftBank, we saw, of course, Arm Holdings giving a disappointing sales forecast for the current quarter. That's now stoking concerns about a tariff-fueled slowdown for the broader chip industry. SoftBank, of course, owning about 90% of ARM. When it comes to financials, particularly here in Australia, ANZ's profit topping estimates in the first half of the year, despite margin pressure curbing growth when it comes to retail and institutional. Cash profit broadly flat, $2.3 billion was the number in the 6 months ended on March 31st. Shery.
Right, Heidi, we do have an alert on the Bloomberg, and we're getting the latest lines from the BOJ minutes from their March meeting. The BOJ did not move in that meeting and held rates steady, but we were watching what they said around trade and potentially coming tariffs. The one BOJ member saying that they would raise the rate if the economic outlook is realized. BOJ members also deciding policy without any preconception. One member also talking about the need to be cautious on the timing of the rate hike if risks continue to rise. Of course, in that March statement, the BOJ had referred to the evolving situation regarding trade and other policies, but this was just about a month before the April across-the-board tariffs that President Trump announced. One member also talking about the downside risks from U.S. policy rapidly being heightened. Market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia Trade. We're counting down to Asia's major market opens. And Heidi will be watching semiconductors here. Of course, we have heard that the Trump administration might be willing to refashion some of those AI chip curves implemented on China. And not to mention that we also got a lackluster sales forecast from ARM.
Yeah, and all of this against the backdrop of really a Fed and a Jay Powell that is heeding patience, right, for these markets. But still, we do have expectations being set by traders for 3 rate cuts this year. It'll be very interesting to see how the data plays out, because it looks like the Fed is not willing to make any preemptive decisions at this point.
We had the U.S. dollar actually gaining ground after that Fed decision. On the other side of that trade, we had incredible weakness for the Japanese yen as well, which weakened about 1% or so against the greenback. Right now holding steady at that 144 level. We're also seeing the Nikkei now coming online by gaining about 0.25%. We do have Nintendo earnings today to watch out for, also Toyota earnings to watch out for. We just got the BOJ minutes as well from the March meeting where they paused and then they did a move on rates, but they were warning about really watching the trade environment unfolding around the world. Take a look at what's happening with the Kospi and the Kosdaq as they come online in South Korea. Of course, we have seen it already gain ground to the highest level since March. We had also seen the Korean won strengthen by the most in about 6 months or so. We are now seeing the 1398 level being kept. We are keeping an eye on South Korea, not only because of automakers and semiconductors, but also because we heard that North Korea has fired an unidentified projectile. So we'll see some of those geopolitical tensions in today's session as well, Heidi.
Yeah, watching as we get into the staggered open here in Australia as well, looking for a second session that's really driven by the financials. It was really down to the ANZ numbers, which have been brighter than market analyst expectations, particularly ahead of that leadership handover. So we'll be watching some of the Australian banks for a second session of gains here. At the moment, just creeping online, a little bit of modest loss at the moment. The Aussie dollar on the front foot, 64.34. As you mentioned, we did see that move when it comes to the rise in the greenback to the day's high, given how much pressure we've seen to the upside for Asian currencies. We're watching how that plays out. We're also watching treasuries as well as broader regional bonds as well. Australian debt has been tracking treasuries higher as well, but we're watching really for bond supply, not just for Australia, but also Japan and New Zealand as well, US auction debt as well. But here in Australia, we are looking ahead to just quite a significant sale that's being expected there, 100 million worth of November 2032 inflation index notes on the block there. But take a listen to what we heard from Jay Powell when it comes to his view on, at the moment, the stability that we still see in the US economy.
Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective.
Right, let's bring in Alex Wolf, Asia Head of Investment Strategy at JPMorgan Private Bank. Alex, good to have you with us. Of course, we saw the dollar rebounding for the first time in about 4 sessions or so, but you're actually telling us in your notes that you have changed your view on the dollar. Tell us about what's happening here.
Yeah, we came into the year still expecting dollar strength, largely driven by rates differentials as we saw higher yields in the U.S. relative to the rest of the world. But we have seen a gap emerge where the dollar has weakened relative to where you would expect from a rates perspective. And that's largely driven by flows, as we see U.S. net investment position as extraordinarily negative, and the rest of the world building up a pretty significant overweight in U.S. assets. And as we're seeing flows and repatriation as a relative growth differential shift, and more money flows back to Europe, more money flows back to Asia. Obviously, what we've seen in Asia FX recently in terms of covering some of the unhedged positions, we think the flows picture will drive the dollar weaker. Not significantly so, and we still see it as very cyclical versus structural, but drive it slightly weaker through year end.
Alex, what does, on the other hand, then mean when we do get Asian currencies appreciating against a weaker U.S. dollar? What are the implications for other assets?
Yeah, Asia currencies tend to either be quite stable, as we see with the Taiwan dollar, or even the RMB against the dollar, or they position themselves as remaining fairly weak. And so as we see Asia currencies strengthen, that does hit exports, that does feed through to earnings. And so there is very much a direct pass-through to earnings, particularly in Taiwan, even in Korea and Japan for that matter as well. So it does have a lot of implications both for the trade picture, for exports, for earnings as well. And then when we think about what it means from a trade deal perspective, as well as the U.S. is beginning to negotiate on the reciprocal tariffs across countries in the region, we could see currencies even continue to maintain some strength against the dollar to position themselves for trade talks. But it definitely does have implications for exports and for earnings.
Tell us about the sort of disconnect that you continue to see and expect to continue to see when it comes to soft and hard data, and how that potentially gives us a better picture of how the US economy is faring going into the second half.
Yeah, that's been one of the biggest mysteries really throughout the COVID period and the aftermath of COVID. We did see, beginning in 2020, 2021, a real disconnect between hard and soft data, whereas before COVID, you tend to have about a 3 to 4 month lag where you had consumer sentiment or business sentiment. Most survey data was leading by 3 to 4 months. It really disconnected where all sentiment data turned negative, but hard data still stayed relatively resilient. So it has made it much harder to try to assess what is going on, at least judging purely by sentiment data. So right now, looking forward, we still see very weak sentiment data, but we have April data looking okay, looking resilient. That doesn't have a full impact of tariffs, though. So we still are very much in a wait-and-see mode. We don't expect a recession, but we're in a wait-and-see mode to see how hard data continues to play out. While April was resilient, you'll see more impact from tariffs in May and in June. And so while we're not really putting too much weight on the sentiment data, on the soft data, we are really looking at the hard data, but it's still too early to really know what the impact of tariffs will be.
And not knowing that, of course, how does that inform your view when it comes to gold? We're up at about 28% this year. Do you still think there's further upside, given that it's one of your conviction calls?
We do. Of course, it's rallied pretty strongly over the last year plus. It really comes back to that dollar view and that flows view. As we see an increase in interest in currency diversification and moving away purely from dollar holdings, whether it's reserve managers or it's corporates and pension funds, there aren't that many other safe havens to go to. There are not that many other markets that are liquid and deep enough as well. So we see gold as somewhat of the natural place to position as our clients and as global investors are looking to somewhat diversify their currency exposure. So we still do see strong demand, whether it's coming from central banks or coming from private investors, that can continue to drive upside. But we still see it in the kind of low to mid single digits in terms of upside.
Alex, what do you think of the semiconductor space? Because we had TSMC, for example, under pressure earlier this week with that huge surge in the Taiwan dollar. Given that we started this conversation with what would be the impact if we do get a rally in Asian currencies on a weaker U.S. dollar, can semiconductors weather this, or do they have a whole different narrative going on for them?
I think from a purely currency position, they can weather it because there's not other competition, so to speak. So currency doesn't play into the demand story as much. I think it's more about the overall demand for semiconductors with regards to what we see from AI demand and what we see in terms of policy from the U.S. In terms of the 232 investigation or what we see around semiconductor tariffs specifically. And where we've seen very strong demand from data centers and very strong build out, and we largely expect that to continue. We have to remember semiconductors are probably the most cyclical of cyclicals. And any signs that we could see weakening in demand for data center build out, weakening in demand from the AI hyperscalers, that does present some headwinds to semiconductors and to broad tech hardware. In addition, just the sheer overhang of uncertainty and risk with regards to U.S. policy also does present somewhat of a headwind. So we are favoring more of the tech software side than the hardware side in terms of how we're thinking about positioning.
Alex Wolf, Asia Head of Investment Strategy at JPMorgan Private Bank. Really good to have you with us. We'll continue to watch those semiconductor names. Of course, we talked a little bit about the potential impact from the gains in Asian currencies, but also with the Trump administration now planning to rescind Biden-era AI chip restrictions. This as part of a broader effort to revise semiconductor trade curbs. We'll continue to watch this space. We're seeing a little bit of a mixed picture because we also had news that ARM gave a lackluster sales forecast for the current period. Revenue will be about $1 billion to $1.1 billion, according to ARM, for this current quarter. And we have seen really the stock gaining less than 1% this entire year. And of course, SoftBank owning ARM, you can see right there the pressure of more than 2%.
We're also watching ANZ at the moment. This is another day we're expecting to see that narrative here in Australia being driven by financials, right? We had profit actually topping estimates, and this is just prior to a key leadership handover before the stepping down of Shane Elliott there. Cash profit, $3.57 billion in the 7 months ended March 31st. We did see some margin pressure on retail and institutional, so perhaps it is that pressure on those divisions that we're seeing a bit of downside, just about 1% when it comes to trading in the first 10 minutes or so of trade. That completion of the 1.2 billion Aussie billion share buyback of a total of 2 billion Australian dollars as well was also one highlight. But a lot of assessment when it comes to uncertainty in broader global macro conditions. Well, still ahead, we'll be assessing the risks of further escalation in the conflict between India and Pakistan. The Brookings Centre for Asia Policy Studies joins us later this hour. But before that, we'll get more on our scoop on the Trump administration's plans to scrap Biden-era AI chip curbs. All of the details are next. This is Bloomberg.
have substantive negotiations, you have to bring down your 145% tariffs. Are you open to pulling back your tariffs in order to get China to the negotiating table?
No.
President Trump saying that he will not preemptively lower tariffs on China to jumpstart trade talks. Well, U.S. Treasury Secretary Scott Bessent is set to meet with the Chinese Vice Premier He Feng in Switzerland this week. This is the highest level trade discussion so far. Our China correspondent Min Min Lo is in Hong Kong. So no preemptive lowering of these tariffs. I wonder how that sort of plays into Beijing's expectations that, sincerity and good faith be exercised going into negotiations to try and resolve a trade war that they say has been started by the United States.
Yeah, exactly. This was exactly China's point, that the U.S. has been flip-flopping, because we've been hearing these sort of hot and cold vibes from the U.S., right? Because Trump's saying he won't preemptively lower tariffs, but then you have Scott Bessent saying that everything is on the table, and he said those tariffs are unsustainable. Previously, Trump had said that tariffs could come down substantially if an agreement is reached. And so it's been really confusing to just, dissect all of these different comments so far. And meanwhile, you have China saying that even though they're agreeing to talks, their stance has not changed at all. Right from the beginning, they were open to talks, but if the U.S. wants to fight, they're going to fight till the end. It doesn't mean that they're going to compromise. It means they are still going to defend their, quote, legitimate rights and interests. So I guess, I don't know if this is part of Trump's strategy of strategic ambiguity to keep people guessing and to lower expectations as we head into those trade talks, but still a lot of uncertainty with how it's going to pan out after the weekend.
Also uncertainty about the semiconductor industry, right? Sources telling Bloomberg that the administration is trying to refashion Biden-era AI chip restrictions. What does this actually mean?
Yes, so the Biden the Biden administration has put in place this AI diffusion rule where he divided the world into 3 different tiers with different levels of export restrictions. And the intention then was to prevent China from being able to skirt around the restrictions to get access to advanced chips from other countries. But the Trump administration is saying this is too cumbersome, it's too complicated. They're going to simplify this, and it could potentially look like restrictions on certain countries that divert supply to China, including countries like Thailand and Malaysia. So it doesn't necessarily mean a loosening of restrictions. Perhaps it will just take a different shape and form. And until they come up with the new rules, the Trump administration says they are going to continue to enforce the existing rules. And of course, this comes after huge opposition from some of these chip makers. Chief among them is NVIDIA, who had been calling for the repeal of this rule entirely, saying that the Chinese market could bring in up to $50 billion in revenue over the next couple of years. He's already had to write down about $5.5 billion because the Trump administration had banned the sale of the H20 chips to China. So again, a lot of uncertainty. We'll have to see what the new rules will look like, but maybe a potential sort of reprieve for certain countries that were previously covered by that AI diffusion rule.
Bloomberg China correspondent Min Min Lo there. Let's get a little bit more about the semiconductor industry with our tech reporter Annabelle Drewlers. Annabelle, we know that investors at least seem to like it, semiconductor stocks gaining ground in the Asian session.
Yeah, that's what we're seeing so far. So these names, big suppliers into the likes of NVIDIA, for instance, that are gaining pretty much in tandem with what we saw on Wall Street overnight. So as Minwin was just laying out there were a lot of criticisms from these big tech giants in the US, essentially, that tiered system was creating a lot of different question marks, essentially. Now, perhaps if this is repealed, it starts to open the door for greater negotiations. And so you're seeing, again, that optimism that's been reflected possibly off these new avenues. But as Mimon was saying there's still a lot of uncertainty. And so that could end up playing into some of the names in the Asian region, because even though if you get countries like India, for instance, a lot of ASEAN, the tier 2 nations, so ones like Singapore, Vietnam, Indonesia, they might get a little bit more space, but still you've got uncertainty with names like Malaysia and Thailand that have often been seen as that sort of conduit where China is able to access this most advanced technology from the United States. So certainly a lot of question marks still to come, but that is the market reaction that you're seeing there so far.
We are also seeing sort of, that sort of SoftBank pressure as well, right? What are the expectations there in terms of that pass-through?
Yeah, well, I mean, SoftBank today is really being reflected or reacting to quite a different story, although I guess still tied into the broader chips theme. But essentially, SoftBank, as we know, it's the majority owner of ARM, and so we had the ARM results coming out, and that guidance from the company was really what traders or investors were paying a lot of really close attention to, because the company is essentially saying for the fiscal first quarter, revenue is going to come in at $1 to $1.1 billion. They're saying that why the guidance came in a little bit lighter than what Wall Street had been expecting is just down to timing. So they've got a lot of different licensing deals that are in the works, but they're not really at the point where they can feel comfortable adding them, that projected revenue to the forecast. This is a company, of course, that designs software for computer chips that then makes money off licensing that technology, also from royalties. But again, I guess tying it back into that theme around these chip restrictions and this trade and tariff uncertainty, that certainly played into the forecast as well. And one of the reasons why the company wasn't able to provide an exact annual target.
Yeah, I mean, the whole theme is really also around the future of artificial intelligence, right? And Apple seems to be becoming a bit more ambitious in this field.
This was one, yes, that had some big moves intraday. So Alphabet was slumped pretty significantly, down around 7 or 8% in the session. You can see there, but this is something that came out. We know that the DOJ, the Department of Justice in the U.S., has certainly got its eyes set on alleged market manipulation or search market manipulation rather by Alphabet, and they're saying that one of the reasons they were able to do that was through a partnership with Apple. So on Wednesday, we heard from Apple giving testimony in this lawsuit, and the executive that was speaking, Eddie Q, was outlining perhaps how Safari could look to revamp its web browser moving forward. And they're saying that actually last month was the first time ever that searches on Safari dipped. And the reason that Eddie Q, the Apple executive, said that this could be happening is because you're seeing more people that are moving to AI search tools instead. And so he's saying they're looking at a range of different ones. So from the likes of OpenAI, Perplexity, Anthropic. Maybe one day they would move to replace the standard search engine browser, and so that, of course, is Apple or Alphabet rather, or Google, and so that sparked a lot of concern in the Alphabet stock. So yes, it's certainly something that could be the major trend and something that has been a big headwind for major search engines like Alphabet already.
Annabelle Jolas there. Let's take a look at some of the other corporate stories that we're following this hour. And Uber shares fell after it reported weaker than expected quarterly gross bookings of just under $43 billion, citing lower inbound travel to the US. The miss on the mobility side was big enough to worry investors, despite better than expected results at the delivery unit. Uber's US rideshare business accounts for more than half of its profitability. Tesla's vehicle shipments from its China plant have declined for a 7th consecutive month. Preliminary data shows the EV maker shipping over 58,000 Model 3 sedans and Model Y sport utility vehicles from its Shanghai factory last month. That's 6% fewer than a year earlier. Tesla's global sales slipped to a 3-year low in the first quarter. Chinese firms BYD and Tsingshan are dropping plans to develop lithium processing projects in Chile due to a slump in prices of the battery metal. The two will no longer proceed with projects to turn lithium carbonate into cathodes used for rechargeable batteries. Lithium prices have slumped nearly 90% from a record high almost 3 years ago. More ahead on the Asia trade. This is Bloomberg.
Investment management giant Guggenheim says they're seeing a possible supply and demand imbalance driving the treasuries market. CIO Anne Walsh told us more about how they're navigating the uncertainty around President Trump's trade and tax policies.
This year, since the new Trump administration, fiscal policy has dominated the conversation. Usually we think about monetary policy dominating, particularly in fixed income. But right now, the real direction of attention is really to what's happening in Washington, particularly around trade, tariffs, taxes, and deregulation.
You know, it's interesting. We're sitting here at the Milken Institute Global Conference, and Scott Bessent spoke on Sunday. It seems like investors were soothed, but the bond market for the better part of the last week has still seen the 10-year yield rising. How do you parse signal from noise here?
So first we have to understand that we're in a trading range on the 10-year, and we've been in it now for 2.5 years, and we believe it's going to persist. That trading range is somewhere between 3.5 to 4.5. And interestingly enough, as investors, when rates rise to that top of that range, it's actually not a bad time to extend duration. But where's the real messaging here? Back to fiscal. The real concern in the bond market is, are we going to be seeing a huge amount of continued Treasury issuance? So we have a supply and demand imbalance potentially. I think that's what's really driving the bond market, at this moment.
So where do you think that this is going to go later this year? If you're sitting here with a 10-year yield close to 4.4%, the Committee for the Responsible Federal Budget came out this week and really warned about the cost to the United States in interest payments for the yield to be that high. Is this a chicken and an egg problem where we're seeing a deficit issue exacerbated just because of the cost of interest rates?
Absolutely. When the cost of interest exceeds the defense budget, I think that's telling us something's out of balance in Washington. So again, all eyes turn to Washington to see what Congress will do with the big, beautiful bill. What's it going to contain? Is there actually going to be any spending cuts? I mean, in order to offset this increased cost of interest, we literally have to return government spending down to levels seen not since pre-COVID, so like 2019 levels. And I'm not sure that that budget bill is going to be able to do that, but we need to really rein in spending and cut that. Now, Treasury Secretary Bessent, when he came here earlier this week, really did talk about the goals of the administration, and that does include spending cuts.
Guggenheim CIO Anne Walsh there speaking with Bloomberg Shanali Barsak at the Milken Institute Global Conference in California. More ahead on the Asia trade. This is Bloomberg.
The Kospi gaining ground right now, 0.2% at the highest level since March. We're seeing the Korean won giving up some of these gains after rising to the highest in 6 months, catching up to the Asian market rally that we've seen in recent days. We'll be watching Nintendo and Toyota earnings today in Japan as well, Haidi.
Watching geopolitics regionally, of course, Shery as well. Pakistan saying that it reserves a right to retaliate further after India launched what it calls targeted strikes on terrorist camps in Pakistani territory. Tensions between the two nuclear-armed neighbours have escalated after last month's deadly attack in Kashmir. Bloomberg's Swati Pandey has been following that story for us. And so, India saying that this was designed to be non-escalatory. Clearly, that is not the impact that we've seen or the response.
That's right. When India blamed Pakistan for this attack, Pakistan did not take that responsibility and, in fact, had asked for an independent investigation. India instead retaliated, and so Pakistan is calling that an act of war. And has said that it will retaliate in turn in self-defense. So it is a simmering issue. The problem has been going on for a very long time, and it's a political lightning rod. Does not look like a resolution is in sight.
We, of course, saw the swift market reaction already in Pakistan and India. Pakistan stocks falling about 3% in the previous session. What are we expecting to be the broad economic implications as well?
I feel like the economic implication for India is greater than that of Pakistan. Pakistan is coming out of bankruptcy, brink of bankruptcy. It is taking support from the IMF. India, on the other hand, India's GDP is 8 times larger than that of Pakistan's. It recently did a trade deal with the US this week, with the UK, sorry, this week. It is also moving very swiftly with the U.S. And is probably seen as an answer to the U.S.-China conflict, with companies moving out of China to India. It is widening its trade manufacturing hub as well. From a reputation perspective, there seems to be more at risk for India on an economic standpoint.
Bloomberg economy reporter Swati Pandey there. Let's bring in Tanvi Madan, who's a senior fellow at Brookings Centre for Asia Policy Studies. Tanvi, really great to have you with us. And as you point out, there's a lot at stake for both sides. Swati just went through some of the economic vulnerabilities for Pakistan. We also know that, India has a full plate of priorities, including with how it deals with China without this sort of other distraction as well. But has this escalated to a point where perhaps you're not so confident that this is going to be de-escalated anytime soon?
I don't think that is inevitable. I think there are three options that we could see Pakistan take, one of three pathways. One is to find an off-ramp. That could be something that they point to their public, that can say that, we inflicted certain losses on India and shape the narrative around that. A second option is that they do actually retaliate because the Pakistani military will want to show the public that they particularly wanted to respond to attacks in Punjab, which is in the heart of Pakistan, and so that they attack and retaliate, but below a certain threshold. The thing that I think people will be most worried about is that they cross a certain threshold, at which point India will say that they will feel the need to then respond resolutely, as they put it, as well. So I don't think it's inevitable. I think both sides are in touch from what the Pakistanis are at least saying. But also, I think you'll have a number of countries, the U.S. included, trying to convey to both sides that at this point they should escalate, and especially to Pakistan at this point, that it should not retaliate. And President Trump indicated that as well just earlier today.
The US on one side, and then we're watching for sort of China's role in this as well. They've also urged for restraint.
Yes, it's actually quite interesting because Pakistan is a very close partner of China. China has been quite supportive, perhaps the most supportive other than Turkey, of Pakistan's statements that calling for an independent investigation of the terrorist attack on April 22nd, also saying that they believed in Pakistani sovereignty and legitimate security concerns. Have also provided military equipment and possibly, though they haven't acknowledged that officially, possibly intelligence as well. These are old partners going back to the 1960s. Having said that, you have seen, as you mentioned, a statement from the Chinese Foreign Ministry indicating that they did express, they called India's military operations regrettable, one of only 2 or 3 countries that have criticized the Indian military strikes, but then went on to say that they called both sides to remain calm and show restraint, and then offered to also work with other like-minded countries in trying to de-escalate the situation. Not clear whether that meant that they would be willing to discuss this with the U.S., or if this meant, Xi Jinping is going to be in Moscow this week, whether that's something that China and Russia want to do. India will not want mediation or anything of the sort from China, which it doesn't consider unbiased in this, but nonetheless, if China does counsel restraint on Pakistan, Pakistani options will be limited beyond a certain point.
Tanvi, how do their national audiences also play into this conflict?
I do think on both sides you are seeing much of, you are seeing a certain amount of shaping the narrative for domestic publics in some ways much more than you are seeing it for the international side. I think this was definitely the case on the Indian side, where you did see. Now, I don't think there was a political dimension that the Indian Prime Minister felt politically pressured to retaliate, as some have said. I think there were other reasons. They wanted a punitive strike. They wanted to disrupt certain infrastructure and send a message to Pakistan. But there was not really that kind of political pressure in the sense that the opposition was united behind the government. Having said that, I do think the Indian public expected a response, and so on that side, I think that was a factor. And I think on the Pakistani side now, the question is there is demands as well for retaliation, so there will be public pressure. There's also this aspect with the Pakistani military, which has been in a way that it hasn't in its history been questioned by some parts of the Pakistani public, maybe saying that this is a way for them to remind Pakistanis of their relevance, of their need to defer to the Pakistani military, and frankly, give them a big share of the Pakistani budget, which they get, to say that, look, you need us because we are the kind of last line of defense against these attacks from India. So I do think that the public view on both sides does play a role. In some cases, you could argue it is a factor that affects the ability to de-escalate. But both sides have shown in the past that whatever the public pressure is, that they know that they have something to lose if this escalates beyond a point, and that they can find ways to manage that public pressure.
If this does escalate, who has the upper hand, both militarily but also economically?
I think, the question asking, about any conflict is, one, how are the capabilities matched? And part of it, what we have not seen these two countries have that kind of conflict for a number of years. Beyond skirmishes or kind of limited strikes. The last time they really had a conflict as such was in 1999. A lot has changed since then. A lot has even changed in their capabilities since 2019. We are hearing reports, for instance, that China is deploying certain Chinese platforms that we haven't necessarily seen in the past. So on paper, you have an Indian conventional advantage. Both countries, of course, have nuclear weapons, but on paper, India has conventional advantages. But India also has a border with China, which has been strained, that they have to deal with, and we don't know how the capabilities match up. So I would say it's very hard to know at this point. On paper, India has the advantage, but as people say, when you actually have a conflict, it's not clear that what we have on paper will translate in practice. I think most people are just hoping and trying that we don't actually have to find out.
Tanvi, Madan, really good to have you with us, a senior fellow at the Brookings Institution, as we continue, of course, to follow the latest developments around India and Pakistan. Now, a top Singapore diplomat has warned there is no clear roadmap to improve ties between the U.S. and China in disputes over everything from trade to Taiwan. Ambassador-at-Large Heng Chee is a former envoy to the U.S. She told us the speed and scope of President Trump's policy changes has been a shock.
President Trump candidate Donald J. Trump ran on the promise of disruption, and he laid out all the policies that he said he would do, and he did exactly that. But still, I think most of us were shocked, and some were awed. Why? I think it's because of the speed in which things have happened, the speed, the scope, and perhaps the extent, and that has really surprised everyone.
If you take a look at Europe, it is building its own defenses. It's increased its defense budget, for instance. If you take a look at South Korea, it's thinking about going the nuclear way. How are you looking at whether or not these countries will undo the measures that they're adopting at this point in time?
I don't think many of America's allies and partners see America as a foe, even though they are very uncomfortable with what the United States, the policies seem to be portending, the tariff war and so on. What do countries do? They try to bargain, talk their way out, see whether you can land at a different space. Because President Trump has been unpredictable, there's reciprocal tariffs and he pulls it back 90 days and so on. So the question is, in the end, who is the target? Are all these countries target, or is it just targeted at China? So, and countries are doing different things. But it is true, you are right. In terms of defense, President Trump has in fact indicated that he wants to deconstruct the order that America has created, that countries should not expect a free ride on American defense and assistance. And in a way, we have been free riding, so countries can expect to pay more. I think that will happen. And so there's some adjustment there. But I think you'll see hedging. They're not foes, but they'll hedge. They hedge in different ways.
You talk about hedging. Does hedging involve getting closer to China? Have you seen that? Do you expect that?
Hedging will, countries at the moment is only 100 days, all right? And people are
quite a good indication of what can be expected in the country.
Yes, I think but there are many countries that are still just trying to deal with the tariffs immediately. They haven't moved to the next phase yet. So, and it seems now, if you look over the 100 days, the countries that dealt or are dealing with President Trump, the United States, with some calm and in a collected, poised way, seem to be having some effect. Show strength, and you'll be respected. So there's a bit of that. If you look at the cases, Mark Carney, Claudia Sheinbaum in Mexico, so countries are remaining slightly calm. And President Trump, he listens, and sometimes he changes his mind. So that can happen. So coming back to your question, then what will they do? So I think in terms of whether they will move towards China immediately, there are signals. China is talking to Europe. Europe is talking to China. What I think has changed most is that what President Biden did, which was to collect all the countries in Europe, gather the Europeans in a kind of coalition, a loose coalition, to balance China, to counter China. I think Europeans are now not going to go there.
Singapore's Ambassador at Large, Chee, they're speaking with Bloomberg's Linda Armin at our New Voices 2025 event. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Japanese assets are trading at the moment. We're seeing some downside pressure for equity markets, with almost every sector on the Nikkei in the red right now, except for technology companies. Communication services, consumer discretionary leading the declines today. We are watching out for Toyota and Nintendo earnings out later today as well. On the right side, you can see NTT at the moment losing more than 1%. We are expecting actually NTT data to start trading and to rise by almost 20% on NTT's tender offer. NTT now planning to make NTT Data a wholly owned subsidiary, a move that's expected to make AI central to NTT operations. But let's talk a little bit more about Nintendo, because Switch 2 is expected to drive the company's fastest pace of annual revenue and profit growth in years, despite longer-term uncertainty stemming from U.S. tariffs on electronics. Bloomberg Intelligence Technology analyst Nathan Naidu joins us now for a preview of the earnings day today. What are you watching?
So for today's results, I think the results itself matter less than, excuse me, any sort of commentaries how Nintendo might mitigate U.S. tariffs. And obviously, Nintendo has a big hardware business in the business of manufacturing those Switch 2 or Switch consoles. And Bloomberg reported earlier that about 1/3 of those consoles are made in Vietnam, with most of the rest manufactured in China. So for sure, will be impacted by tariffs to a large extent. And so that's what I would be watching out for.
Yeah, the tariffs really loom large, right? What sort of impact could we see when it comes to the console business, if not in these numbers, but the ones going forward, certainly?
Yeah, so lucky enough for most electronics makers, they have had a bit of U.S. stockpile on the ground in the U.S., and Nintendo is not an exception to that. Nintendo can also maximize shipments to the U.S. from areas that are still with low U.S. duties within the 90 days reprieve, and we are about a month into that 90 days, so we'll definitely see impact beyond that 90-day reprieve. But from my analysis, I think for the first year at least, Switch 2 sales would probably be unscathed from U.S. tariffs. But beyond that point, Nintendo might have to raise prices by up to 30%. And bear in mind that Sony and Microsoft have already bumped up prices of a few variants of the PlayStation 5 and Xbox by more than 20%. So Nintendo might follow suit later on.
Bloomberg Intelligence Equity Research Analyst for Technology, Nathan Naidu there on Nintendo. More ahead here on the Asia Trade. This is Bloomberg. Well, tourist arrivals to Hong Kong jumped in the first quarter, boosted by efforts to repair an image that was dented by COVID and political turbulence. Hong Kong's Tourism Board is forecasting a 10% growth in visitor arrivals in 2025. We spoke exclusively with the city's tourism secretary about the challenges ahead and how they're attracting non-Chinese visitors.
I actually see pretty handsome increase of visitors from outside of Asia, or within the short haul of Asia. For our long haul, which primarily means a flight more than 5 hours for the long haul visitors, we see double-digit growth last year and this year. 31% growth from Australia. I think close to 20% growth for the US and the UK, for example. I think these are signs that people are actually still traveling, and with the resumption of flight capacity, the subsequent or consequential drop in air flight ticket fares, and also the fully operational free runway system of Hong Kong, actually we see that our overseas visitors are coming back.
Are you doing enough to attract those non-Chinese visitors?
We are doing more and more, actually. The Hong Kong Tourism Board has been doing quite a lot in these ASEAN countries. I actually just now led the delegation to the Middle East. I went to Dubai, Abu Dhabi and Riyadh, and we were doing a trade delegation visit to the Arabic truffle market. And I think we are keeping and increasing our work in the traditional markets. There's no question about it. We are also exploring new markets. So the figures actually speak for themselves.
What are you doing for the U.S. market?
The U.S. market...
Because there's threats that perhaps those Hong Kong trade offices might be closed. We all know about the trade war.
Well, we are doing nothing to the U.S. We maintain a zero tariff, separate customs territory, a founding member of the WTO. We have not imposed any
reciprocal tariffs.
Reciprocal tariffs. I don't know how reciprocal that is because Hong Kong adopts zero tariff. So we're doing nothing. We basically did nothing to undermine any of it. On the other hand, we actually welcome everybody. Hong Kong's door is always open. And you can see for yourself the increase in visitors from the United States. You can see that Hollywood movies are now still being staged in Hong Kong all the time. Even when we are faced with different threats of tariff or other things, Hong Kong remains a free port.
What is your main number one priority to achieve this year? You have a pretty strong mandate and remit from the Chief Executive, John Lee, to get this thing going.
I think it's to bring the best possible visiting experience to all kinds of visitors in Hong Kong, to show them what Hong Kong is all about and to give them a reason to not just come once, but after coming once, they remember us, they miss us, and come back to be a loyal supporter of Hong Kong.
Hong Kong Tourism Secretary Rosanna Law speaking exclusively with our Chief North Asia correspondent Stephen Engel. Take a look at how futures are trading. TAIEX futures now pointing to the upside of 0.6% as we're seeing broad upside for semiconductors across Asia. We'll be watching TSMC. We heard that the Trump administration plans to refashion a Biden-era policy restricting chip exports. A50 futures in China pointing to the downside despite the fact that we've seen just in the previous session those new measures in order to support growth. Now, we'll be watching Chinese bubble tea chain Auntie Jenny making its Hong Kong debut today. We'll be hearing from its CEO, Shang Wei-jun, in the next hour. That's it from the Asia Trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China Show is next. This is Bloomberg.